be talking a little bit about ICT trading, and he is single-handedly one of the best traders I've ever learned from, and I'm going to be going over some of his ideas, breaking them down and putting them into a really short video. So here's essentially some of the ideologies or setups that he looks for, and I'm going to break them down. Now, first of all, old highs are old lows. Now, when you think of highs and lows, what comes to your head? A lot of people think of support and resistance and consider that as places they should set their stop loss. And this is completely wrong. If you're setting your stop loss above these highs or on these lows, depending on long or short, well then you're just doing it wrong. Because these are the exact locations where banks and institutions are actually putting their orders into. Because they know their retail are putting their stops there. And where there's stops, there's liquidity. And where there's liquidity, that's where they can enter their orders. So commonly, what you're seeing FX, sort of in crypto as well. Crypto are just much more aggressive with it. You see a break of the previous high and then instant reversal. And that is why when you're in a trade and you feel like every time you're getting your stops hit, the price reverses, well, guess what? Because you just provided liquidity. That is literally the point. Like, your stop getting hit is literally the point of what the institutions are trying to do there, because they know there's lots of retail putting their stops in. They need to buy in at a place where there's lots of liquidity to enter there. You have to imagine it's actually quite difficult to trade millions of euros or dollars or whatever, pounds, in FX or crypto, because you need to be entering in an area where people are selling or buying, depending if you're long or short. So commonly actually, you should be looking for old highs to be entering your positions. So here, what you'd be looking for, you'd look at your interest should be taken, or your interest should be drawn, should I say, when you see this high being broken and then it comes down. You should then be considering an entry. Same goes for lows. Equal old low, price moves down and we go up. Although this is very drastic, unless this is like the second time frame, but you would commonly see that once the low is taken, we'll start to reverse. Clean highs is the exact same. Market makers will create a false sense of resistance. So here, this is why you shouldn't really be going short here. Yeah, you might make a few buck, but you're essentially, they're setting up for a false move above. And you'll have breakout traders who will long this year and get wrecked. Same goes for the lows. Equal lows taken, and price reverses instantly. You even have a bit of a W-shaped reversal here. And again, this isn't to do with stops, but any aggressive move down or impulsive move is more than likely gonna be reversed. You see, if often large candles like these with no wicks to them, well, you will see price reverse and tap into these candles. When you see it tapping into this large body here that has never been tapped before, and you're noticing these wicks and a stopping volume candle here, it should be a fair indication the price is going to start reversing again, and you should go short. Now, here as well, liquidity voids. It's what is it? You commonly get these during CPI or high impact news. There'll be lots of orders created. Price have moved down. You could possibly call it supply and demand here. There's demand created here. Price moves down and we see a move back up. Swing high is similar to what we saw earlier. Price a move into candles that have not been previously touched before. You will notice you'll have a few wicks to the high here, maybe 2 or 3. Rule of thumb is generally 3 here. 1, 2, 3, and price moves low. Here's the opposite. I'd argue this is more supply and demand. Demand is created here, and price reverses. Now I hope this has helped you guys. The main bit I want you guys to focus on is these clean highs and clean lows and old highs and old lows. You need to forget support and resistance. You need to start thinking like a bank or an institution. These setups here are actually the easiest to see, because when I see equal highs like this, I instantly think don't short. I'm even thinking if price moves low enough for me to a suitable risk to reward ratio, I'm thinking long, if anything, and then shorting this move above here. Whereas the old highs and old lows, you are sort of taking a gamble because price could continue up or down. You have to just use confidence. Now I hope this has been of benefit to you guys. This is really important stuff, and I hope you can use it well. Thank you.